All right, so this one we're going to go over error correction at a minimum. We might get a little bit further than that, just sort of again trying to keep these videos at around 15 minutes. And so let's kind of walk through this one. And the reality is, at the end of the day, errors are a part of accounting, unfortunately. And so when an error is made, obviously a company needs to correct that error. And so the key though is with an error, you obviously need to correct the year that you discover it, but you also have to go back and look at, okay, did that error create or was that error present in prior years as well? If it's, and I would say most of the time the error is discovered in the current year. And in those cases, the correction's probably pretty minor and it might just be an adjusting entry or something like that. But you haven't put out financial statements or anything like that. So you're just kind of making a correcting journal entry. But if it's discovered, a year later or after your books are done, after you've created financial statements, or especially, multiple years later, then there could be a ripple effect through several years. And that's when you have sort of a larger issue and you've got a lot more going on. And so, again, most are discovered within the current year. And so the correction is minor. The vast majority after that are discovered within 1 year, but you could potentially have multiple years where there's been a mistake. Um, Errors can be difficult to navigate, depending on the number of accounts affected and the length of time. Now, I will say one thing is, we are obviously in the property, plant, and equipment, and tangible asset, and natural resource chapter. So the error we're going to cover here is really focused on that. And so most of the time, there's different kinds of errors, but I would say the most common error is a misclassification of a cost. And so, in other words, you expense a cost that should have been capitalized, or you capitalize a cost that should have been expensed. Those are the most common errors that I'm going to call a legitimate error. And you can see where there might be some judgment and somebody might not make a mistake or come to a different conclusion later on or whatever it might be. That's kind of the most common example. Obviously, there could be things like you leave out the residual value or you have an error in computing the capitalized cost or you use the wrong service life or there's a lot of other clerical things that could happen. But I would say as far as like judgment, it's usually should have I capitalized this cost or should have I expense that cost? That's usually kind of at the core of it. And so I like going through this error correction because it really pushes you to understand how your financial statements are affected if you capitalize a cost versus expensing a cost immediately. But major things to consider whenever you have an error. One is, we do need to go back and correct any prior financial statements that would have been published with that erroneous information. There may need to be a journal entry to adjust the account balances. Um, if retained earnings requires a correction, just as an FYI, it is reported as a prior period adjustment on to retained earnings. And so, and then finally, you would need to describe in a note, or sometimes they'll actually do a separate press release describing the nature of the error and the impact of the correction on income. I think let's walk through this example here. A company purchased a piece of equipment for 300,000. The company paid 25,000 to have the equipment installed and tested. Now, if you recall, when you have $25,000 in installation and test costs, those costs really should be capitalized. And so instead of having a $300,000 piece of equipment, you really have a $325,000 piece of equipment. They assumed a zero residual value and a 5-year useful life. And then on December 31st, 2025, and so all of 23 would have, or half of 2023 would have been an issue, all of 2024 would have been an issue. And then we got to talk a little bit about what the effect might be in 2025. And so let's talk about that one in a little bit. The company's accountant discovered that they had mistakenly expensed the 25,000 instead of capitalizing it. And so now they're going to walk through and say, okay, we need to correct this error. We need to basically retrospectively go back and say, okay, we need to act as if we had capitalized this cost all along and make those corrections. And so, first of all, need to kind of understand, okay, what did we actually report? What was the original reported amount? And the answer is they would have reported $60,000 a year in depreciation expense. Now, again, that's an annual depreciation number. And then in 2023, it was only a partial year. And so kind of thinking through that, of course, the cost would have been carried at that $300,000 capitalized cost. The accumulated depreciation in the first year would be, a third of a year, right? Because it's only, I think we bought it on, what day did we buy it? July. It was half a year. Sorry. Sorry. So it'd be half a year. So $60,000 for a full year. In 2023, of course, it's only half a year. And then a full year of depreciation in 2024. So we go from $30,000 in accumulated depreciation, add a full year of depreciation, and we get to $90,000. So again, this was as they originally reported it. They would have reported an installation and test expense in 2023. And again, the depreciation expense for that first year is only half a year for 30,000. And in the second year, it's a full year of 60,000. And then what should they have reported? Well, they should have capitalized that cost again over the same 5-year period. So that would be $65,000 per year. So that's how much they should have reported, was 65,000 per year. Of course, they only reported 60, but that should have been the depreciation expense. And so be a little bit different in that, the equipment now would have a capitalized cost of 325,000. In the first year, of course, it's only half a year of depreciation, so the accumulated depreciation would be 32,500, and then add another 65,000 to get a full year added to it of 97,500. And on the income statement, there would be no installation and test expense, but instead the depreciation expense would be half a year in 2023 and a full year in 2024. Now, one thing we want to talk about, again, we're sort of doing a side by side. And note, we're assuming in this case that we discovered it on December 31st, 2025, before we did any adjusting entries. Now, if the company had been doing adjusting entries like every month or every quarter, then there would be some entries to do for 2025. But in this case, we didn't have any error in 2025. We didn't compound the error in 2025 because we haven't done the adjusting entries yet. And so what we need to do though is we need to figure out, okay, what were the compounding effects on our accounts from the mistakes we made in 2023 and 2024. And so again, you can kind of look up here and ballpark it. First of all, I think we can see that the equipment balances are different, and we can see that the accumulated depreciation amounts are different. And so we'll kind of cover those first because those are the easy ones. And so you can see that, the corrected amount, we need to increase the equipment $25,000. We need to actually change that account balance. And at the same time, if we look at our accumulated depreciation, again, we're going to focus on the accumulated effect. It was stated at 90,000 originally, but of course we know the balance should be 97,500. And so we would go through and increase that by 7,500. Now, I will say in some accounting systems, you'd actually have to go back and make two entries. You'd have to change, so you'd go back and sort of make the adjusting entry in 2023 correct, and then correct another adjusting entry in 2024, and then kind of reprint your financial statements. But what we're doing is we're kind of accumulating all of those mistakes just sort of in one financial statement, or sorry, one financial journal entry. Now, the piece of this that you might sort of hopefully have already figured out is that, we have a debit of 25,000 and we have a credit of 7,500. And of course, the issue here is that those are not equal and they need to be. And so, obviously you can pause this or whatever, but we got to think about, okay, what's the other part of this transaction? And so, again, I want to be clear, we haven't done any adjusting entries related to this in 2025, which means the only accounts that can be affected are permanent accounts. Now, if we had been making some depreciation expense related journal entries, but had not closed out the depreciation expense account, then there would be a correction to depreciation expense. However, since everything, all the mistakes that we made in terms of our depreciation expense and our installation and test expense, since all of that has been closed to retained earnings, the correction is going to be to retained earnings. So just to be clear, the reason why this is all in retained earnings is because as far as our accounts are concerned, there are no temporary accounts that still have an error in them, because this installation test expense account, that was closed to retained earnings. these depreciation expense from 2023 and the depreciation expense from 2024, those were closed to retained earnings. And so there's no temporary account that still has an error in it as of this date of December 31st, 2025. And again, just to be clear, the reason why is because we haven't made any entries to depreciation expense in 2025 prior to discovering the error. And so then how do we figure out what the amount should be? There's sort of the easy way, which is I need a $17,500 credit. I feel like that's not a great approach. Instead, let's think about it. Think about the total expenses. So all of these expenses would have been closed to retained earnings. And so I've got on this side, I've got $115,000 of expenses. Those would have been debit balances. When we close them, that would have been $115,000 in debits to retained earnings when we close those accounts. You can see here, though, that we should have only debited the account retained earnings. We should have only debited the account 97,500, which means we over debited the account. And so to correct an account that has too high of a debit balance, we need to credit that account. All right. And what that means is because the expenses in a cumulative amount were too high, that means that the expenses are too high, which means retained earnings then is understated. If expenses are overstated, then retained earnings is going to be understated. And so again, to correct an understatement to a permanent equity account, you need to credit that account. And I would say this is where students probably get tripped up more than anywhere else, is figuring out, okay, what actual journal entry do I need? All right, so looking at the three accounts, hopefully by now the journal entry itself isn't too difficult. But of course, we're going to debit the equipment 25,000, credit accumulated depreciation 7,500, and credit retained earnings for 17,500. And so when we think about the way the financial statements are impacted, we did it side by side, so you can kind of see this here. I'm just sort of like quantifying it here in this final slide and saying, okay, well, kind of taking all of our accounts, we can kind of see that, obviously equipment now needs to be corrected. It's going to be stated $25,000 higher. Accumulated depreciation is a negative number, so we're going to decrease it. It's going to be more negative in the first year and even more negative in the second year to correct for the under depreciating the asset. Retained earnings, again, this is the cumulative effect. And so in that first year, the total mistake, again, we have $25,000, maybe the easiest if we pull this up. We can see that, our installation expense, it needs to decrease. If we decrease an expense, it's going to increase retained earnings. But it's offset in part because we need to increase another expense, which is going to decrease retained earnings. And so the net effect of this is that we need to increase retained earnings $22,500. And then remember, retained earnings accumulates the effects on the income statement. And so overall, there was an increase of 22,500 in retained earnings in 2023. And then we get to 2024, and this we need to increase our depreciation expense, which would decrease retained earnings. And so the accumulative effect of that is, well, originally we had to increase it 22,500, and now we're going to decrease it by 5,000, which again is just because of this difference in depreciation expense. One thing I think this highlights, and if you kind of think about moving out here to the right, is that $25,000, it was going to be expensed. I mean, there's no way around it. It was going to be expensed. It's just a matter of in our mistake, we expensed it in the installation and test expense. But once we correct that mistake, eventually it's going to show up as depreciation expense. And so we're not avoiding the cost. In other words, over a long enough period of time, over the 5-year period, it would have ended up in the right place. But the issue is because we made a mistake, even if we had discovered it, let's say we discovered it after we fully depreciated the asset. Well, at that point in time, retained earnings is okay, but the issue is the balance in our equipment is wrong, and the balance in our accumulated depreciation would have been wrong, and these financial statements every single year would have been wrong. And so just because overall we get there, it doesn't mean there still wouldn't be a correction. But just to be clear, whenever we make this change between a capitalized expense versus depreciation expense, over a long enough period of time, the expense would show up. It's just a matter of it's going to show up now in the correct way, which is through a higher depreciation expense. All right. Of course, net income is impacted, just kind of close that off. The net effect is what rolls into our retained earnings. I'm going to stop there and we'll do impairment on the next one because I think we're right at 15 minutes. So we'll pick up this. Might get all the way through the last recording all at once. We'll see.